Good afternoon, everybody. Good morning to my friends on the West Coast. Hey, and in the mountains. I'm Mark Sebastian. I am your only, actually, you know what? I'm Clark Sebastian today. I'm one of many options. Clark Sebastian is my secret identity. I don't know if you knew that. So I'm Mark Sebastian. I am your only option. Welcome to the Great Income Reset Day 2. I'm excited you're all here. Yesterday, we dug deep into what's happening with the bond market. And we talked about how the bond market isn't what it used to be. It's not doing what it needs to do. And, you know, and we talked about the scale, the death of the 60-40 portfolio and how it just doesn't work anymore. So that was kind of the big idea of what we discussed. And we continue to see that. This afternoon, we're going to get we're going to get the final meeting of the FOMC with Jerome Powell as head of the Federal Open Market Committee. And then we start with Warsh, and, you know, we're going to be in a period where bonds might go up a little bit, but not while we're printing all this debt. You know, when people say, well, why is the bond market such a problem? The answer is that U.S. debt is exceeding the size of the U.S. economy, and that becomes a real problem. So let me know where you're in from. I'd love to know where you guys are coming from. And then second, type in a 1 if you are with a financial advisor that is still pushing the 60-40 portfolio. Type in 2 if you've started to free yourself from the 60-40 portfolio. Let me know where you're from. And then a 1 if you have an advisor that is still pushing that on you. And 2 if you have freed yourself or begun to free yourself from the 60-40 portfolio. Nixon, St. Louis, Salisbury. Nice. Yes. Good. I see many of you are on your way to being free of that 60-40 portfolio. Now, one more question. Do you have a portion of your portfolio still, regardless of the bond piece? Do you have a chunk of your portfolio that is producing income? Type in a 1 if you do, and a 2 if you don't. And I'm going to ask you one more question after that. All right. Mark Sebastian fan has an income piece. Jim's getting dividends. We're going to talk about that today, Jim. Finn does not. All right. I like that. Spy Harris, 2. Yes. You guys all love dividends. Well, we're going to talk about that. And then the final question is, on a scale of 1 to 10, how effective is the portion of your income portfolio at accomplishing your goals? 10 being it's the Bo Jackson of accomplishments. 1 being it's the Bob Uecker of reaching that portfolio. How well do you feel like you're doing on a scale of 1 to 10? We got some 2s. I got a 6, 3.5, 4. I see a 1. I see a 3. I see a 5. The highest at William's 10 plus. Congratulations, William. But William being the outlier, the highest number I'm seeing is a 6. Howard just dropped in a 7. Bob Uecker. I love Bob Uecker, RIP. I'm seeing a lot of 2s, a lot of 3s, a lot of 4s, and maybe some 5s and 6s. And I'm here to tell you that is not enough. Your income portfolio, maybe you're not a 10. It's very hard to be a 10. There's only one Bo Jackson. But it should be 8 or 9 or 10. It should be 8 or 9 or 10. And that's really what we're here and what we're talking about and what we're going to be working on today and tomorrow. So, with that, let me get our slideshow going. And again, welcome to day 2 of the Great Income Reset. I'll be joined by Hans in literally 1 second. And what he's discovered is the Great Income Set. This Great Income Reset has taken research, years of research, trend spotting, and market analysis. And what we've noticed, and we started to talk about this yesterday, is that what used to work during the 80s, during the 90s, into the aughts, basically 5-6 years ago, completely stopped working. And Option Pit is 16 years old, believe it or not. We just celebrated our 16th birthday. And for 14 of those years, primarily me and Andrew, but then Leisha and Frank, and now Hans and Tim, but primarily, all we did was really buy options. And we were good at it. It's hard to argue that Andrew and myself and Leisha are not excellent at trading options and using long calls, long puts, butterflies, debit spreads, credit spreads, debit spreads to express our directional opinions or our non-directional opinions. Coming out of COVID, watching a lot of people miss that huge run up. And then it happening again in 2022 when everything sold off and a lot of people missed the boat. It made me realize we need to help people not just trade. We need to help people with the entirety of their wealth. And by that, I mean investing. Now, I had known Hans for 10 years. Just so happened at about the time that I was starting to realize I needed someone that could provide investment income through trading that Hans decided to, Hans's large mutual fund that he was running ended up getting merged with another mutual fund. I believe this is the whole story. Merged with another mutual fund. Hans was like, I'm kind of out of here. I'm going to go do my own thing. And he and I struck up a conversation. And I said, Hans, I need help. He said, Mark, we know. And I said, no. I need help in that our traders here at Option Pit, they want access to income. And they want understanding of how to invest with income strategies. And he said, Mark, I'm your guy. And knowing Hans for 10 years, I took him at his word. And then I verified and I saw what he was doing. And I said, wow, Hans, you're creating income that most people would dream to get, and you're doing it in a way that has really low risk. That's really hard to find in this world. And he said, Mark, I know, I told you. And I said, well, Hans, you gotta come to Option Pit. And he said, well, Mark, I've known Option Pit for a decade, and I know how good a guys you are. And I know how wonderful the people are here at Option Pit. He said, I'd love to work with you. And thus, we brought Hans on board. And so I pay it when Hans says something, I pay close attention. And now we're going to bring Hans on to guide us, lead us through the Great Income Reset. And I'm looking forward to hearing what he has to say. So with that, let's bring on our own head of income trading, Hans Albrecht. Good afternoon, Hans.
Good afternoon, Mark, and welcome everybody. I remember that a couple of years ago when you met me downtown Toronto, and I really impressed you when I took you to a restaurant that was actually closed. I hadn't been downtown in so long. And it was in that moment that you thought, based on Hans's fancy car and attitude, he has got to be a better trader than tour guide. And it's true. But we eventually did end up eating lunch, and it was a great meeting. So great to be here again.
Yes. So Hans, what are we talking about today?
Well, look, we are talking about day number 2 of our extravaganza, our income reset extravaganza. We talked about how bonds are basically dead. We had a bit of a eulogy for bonds, right? They worked when it was simple. Things were simple. And so we're going to talk a little bit more about some other things that you have to know as we continue along this path of why there's been this big income reset.
Yeah, we're going to be talking about precious metals and what their role is in your income portfolio, in the stability of your portfolio. We're going to talk about dividend stocks. Now, a bunch of people said, no, I don't own bonds. I own dividend stocks. And we're going to be talking about the problem there. And at the end, so make sure you stay for the whole thing, Hans is going to be talking about a new safety stock from Hans that pays a nice dividend that he really likes. So that's going to be the first piece of kind of actionable. That's going to be an actionable item that you can take advantage of today. So Hans, like you said, bonds are dead. You gave them a bit of a eulogy. Talk to me about, just quickly review what the major points were yesterday.
Well, this is it, right? We used to live in a different world. You remember the last decade in the 2010s when we didn't really have any inflation. So because of a number of things that include inflation that's sort of all over the place. Again, look at oil at highs again, really contributing to this sort of sticky inflation situation, which makes it very, very difficult for bonds to rally. And higher inflation is also not a favorite thing when it gets a little bit too high of stock. So we have this sort of correlation, unfortunately, that's been playing out. And I think volatility is here to stay. I think inflation is here to stay. Sticky inflation is here to stay. And so this is it, right? So bonds are more correlated to stocks than ever. And this is an issue with our 60-40 portfolio, which is, as you guys know, or perhaps don't know, 60% stocks, 40% bonds. One's supposed to kind of help out the other, right? When stocks aren't doing well, our portfolios fall into the warm embrace of our bond portfolio, which unfortunately doesn't really help anymore.
Yes. Now, we're going to dig into the meat here of today. But before I do that, I have to remind everybody that what you're about to be presented from Option Pit LLC is for your information and educational purposes only. We're not issuing investment, legal, or tax advice of any kind. So if you see something and you take action on it, you do so at your own risk. So Hans, yesterday, as you said, you talked about how bonds are dead. They've
We
lost
can
their
cross
stability.
those off the list, right? We're crossing bonds off the list, and we are going to move on. This is the Great Income Reset. And these strategies that people have relied on for years, and we know business is not as usual, and this is not our father's stock market or grandfather's stock market, and especially with AI and the disruption that's coming from that. And that plays into all of this as well. So safety assets, precious metals, dividend stocks, we're going to get into those today.
Yes. Now, we're going to talk precious metals right now and gold bugs. And I know there are a lot of you out there. I know you've had an amazing run, but we're not here to say don't own gold. We're not. But what we are here is to adjust your thinking about how that asset fits into your portfolio. Is it part of that 40, or does it maybe belong in that 60%? Same thing with dividend stocks that a lot of you own. So we're not saying don't own these or never own them. What we're going to say is change the way that you think. So Hans, why isn't, so, give us a little history of gold, and, we're going to get into why it's not reliable, but let's start with just, what is the point of owning gold?
Well, it's always been considered that safe haven asset, right? A little bit tin hatish too for the folks out there who lean a little bit in that direction. But when the market gets scary, people run to gold. It has this history of holding value, through the millennia, through inflation and geopolitical shocks and things like that. So the U.S. has the dollar, Japan has the yen. Every country recognizes gold. That's the amazing thing about it. There's no counterparty risk the same way that a company does. If Apple gets into trouble, well, nobody controls gold, right? It's its own sort of entity. So it really has this kind of unique store of value that had worked for many, many years, but it doesn't pay a dividend. But really, like bonds, the point was never really income. The point was stability.
So yeah, here's you can see a nice stable flow of gold. It had a nice little run in 2012, but gave that right back and continued along this path. And this 10-year period, gold kind of just tracks inflation. Wouldn't you say, Hans?
Slow and steady, absolutely.
So, this is slow and steady. What are we looking at here in 2017, Hans?
Well, now a little bit more recent. We talked about this yesterday with bonds, how things have sort of changed a little bit. And so it sort of starts the same way, slow and steady, pretty boring, paint dry kind of stuff, and then boom, look what happens here. Something drastic changes, and we see that we get this huge spike. This massive run that we were referring to, that we were thinking about. Gold reaches those record highs over the last few years. It moves to 4,000, it moves to 5,000. Everyone's like, how can it go any higher? But gold isn't a company, right? It didn't report great earnings or anything like that. So what really made gold go up, right? That's what people are going to wonder.
I'm wondering the same thing. I'm not a gold bug. I owned it. I got some access to it, but what caused this just absolute ramp in gold from really 2017 and then 2023 to 2026?
Yeah, and so look, you've got a number of reasons. You've got, the last couple of decades have been pretty action-packed, I would say, but we've got COVID more recently, a very, very sharp rise in inflation, of course. We remember that as we were, stuffing our pantries with toilet paper and things like that. Very, very interesting times. The Ukraine war, of course, tariff trouble over the last couple of years, a very volatile administration, let's say. Gold was kind of doing what it was supposed to do, providing that safety when investors get nervous. And what is the one thing that really kind of ties a lot of this all together is that in a world of globalization, let's take a look here, it's global economic uncertainty. Right now, things are being felt very deeply around the world. So there has been a lack of calm in the world, and gold can certainly calm down. And as it calms down, we are going to see this spike revert a little bit. We talk about mean reversion sometimes, and it's going to be less stable. So it really used to be this kind of, think of gold as having been sort of almost the supports, right? The supports of there are walls in a house that are the support load bearing walls. It used to be something like that. It's not like that anymore.
Yeah. And, you know, I think that we can see that in the volatility that we've seen in gold, right? I mean, gold is not slow and steady, and it hasn't been since 2017.
It's more volatile than ever, right? So, and like we talked about with bonds yesterday, volatility kills that concept of stability. And that huge run over the last few years, is kind of proof of that, right? We're in that period of economic uncertainty. Investors are scared. They're running into gold. And as a result, we're seeing some big moves out there.
Yes. Now, I want to illustrate to you what I mean by volatility in gold. So what you're looking at is how volatile gold has been over the last year. Volatility is price, another way of saying kind of price sensitivity. How much gold is moving around up and down and up and down. And what do you notice about these last few years relative to what we'd seen in the past? Look at these spikes, and then look at the way it gives it right back away. You've got a huge spike in April when we had the carry trade mess. You had a huge spike in October. Massive spike in February around Liberation Day. Another follow-up spike when we had the Iranian conflict begin. And each time it spikes up and falls right back down. That, to me, doesn't really say stability, right? Does this chart look stable to you guys? It certainly doesn't look stable to me.
Yeah. So look at the catalyst that we've experienced. I mean, first that we had the tariff tantrum, gold ran up 9%, then it dropped 3%. Okay. It does that. October, we had inflation and incoming rate cuts. Gold moved to 4,000. It ran about 12%. Then it dropped 5%. Not very stable. That's a little bigger. Then in February, we had the Iran war, weak employment data and more tariff threats, etc. Gold moves towards 5,000. We see it run up about 17%. Then it drops 14%. Remember that move? I think we got to almost 500 on the GLD. We got back down to 400 again.
Crazy.
Just massive move. So one thing to notice here is those drops keep increasing, right? We're getting more and more volatility. And that's not exactly that sort of steady paint dry asset that we need for a safe portfolio.
No. And so remember that 40% is about stability. We're not saying don't own gold, right? When you think of assets that have volatility, Hans, that most investors own, what asset do most people think about? Stocks.
You think of stocks.
They think of stocks. So gold has lost its stability. It's volatile. Gold, you can own it. But and Hans, stop me if you think I'm wrong, but I feel like gold belongs in the stock side, not on the stability side that 40% makes up. Is that kind of your conclusion here?
It's a little risk on, risk off. There's no question about it. Crashes are very severe. The rallies are very impressive. And so it's just not that same stable asset. Now, the interesting part is it doesn't give you any yield. And we're going to sort of lead to the point that we can actually generate a yield with some strategies that are very, very interesting. But yes, it is not stable exactly.
All right, so we've just crossed another one off the list of income strategies people use, and now the one I heard the most when I don't know if you heard at the top of the show, I asked everybody, do you still own a lot of bonds? Are you part of the 60/40? A lot of people said no. I get my income from dividend stocks. All right, well, Hans, let's talk about dividend stocks.
Yeah, so dividend, pretty simple. I'm sure a lot of you know this. You own a stock, dividend 101. The company pays you a dividend from its net income. The company decides how much of that income to pay out. The stock price is going to affect what you get as a sort of yield from that over time. So what we've seen is that we've seen a real compression of dividend yield in the S&P 500, and that makes it much more difficult if we have this sort of search for yield that is, of course, is always a part of almost always a part of people's routine, is looking for something with yield. And that's gotten very, very lean.
So high yield, does that equal a return, a high return, or, is there something else going on here?
Well, and this is the trap, right? We look around and we say, well, what's giving me some higher yield? And so you look and you say, well, that's got to be better because it's giving me a higher yield. But higher yield can often mean that higher risk. A dividend can be reduced. It can be canceled. If a company has financial stability issues, disruption to the industry, that sounds familiar, right? We're talking a lot about disruption. So we see these dividends getting sort of squeezed a little bit, mostly from stocks going up, and now you're just not getting very much from a dividend yield standpoint, and that's a problem for yield investors.
Yeah, I mean, I think a classic example would be a name like Comcast that for years was stable, paid a dividend, and now we've got streaming, and it's gone all. And I don't think anybody feels great about Comcast or these other cable providers. I think you hit the nail on the head. So let's look at your typical dividend stock.
The dividend kings, right? The dividend kings. This is kind of some of the old guard, right? The old guard, Procter and Gamble. We've seen them increase their dividend for 70 years. Coke, 63 years. J&J, 64 years, et cetera, et cetera. So that's great. Every year you're benefiting from that. But look at how these guys have been performing now, right? This is sort of, that's a little bit in the rear view mirror a little bit at this point as we continue to search for yield.
Yeah, I mean, here's the annual returns on these names. And I'm noticing a trend here, Hans.
Stability and income. But look at what's happened since then, right? The performance not as strong anymore. These companies aren't going anywhere. They're not disappearing. They're not bad businesses or anything like that, but they're not leading the market the way they used to be. And when performance weakens, that affects how these stocks provide that important stability to our strategy.
Yeah, their dividend yields are getting smaller and smaller and smaller. We still drink Coke and we still need toothpaste. Well, I don't really. I'm more of a Diet Dr. Pepper guy. But to say that Procter and Gamble and Coke and J&J and Pepsi are leaders, I mean, who are the kings in the stock market now?
Well, we know who they are. There are beloved tech stocks, the names that we have known and loved for so long, had a little bit of trouble lately, are staging a little bit of a comeback. So don't miss us tonight after the closes. We talk more about these guys.
Mm-hmm. Yeah, you've got Microsoft, Meta, Apple, Google, NVIDIA, and Tesla. But two of these don't pay a dividend, Hans.
Nope. These guys don't pay dividends, right? They don't need to. They give you the promise of moonshots and dreams, right? And so that's what makes it tough. You are sort of being pushed into a volatile world, whether it's a dividend stock, whether it's a tech stock. So you're thinking, well, what if I just buy these stocks for dividends? Okay, these guys pay a little bit of a dividend every now and then. They throw you a little bone. Well, look at that. You don't really get very much, do you?
I would say no. I mean, NVIDIA pays less than 0.1% yield. I mean, almost like 0.2% is what NVIDIA is yielding right now.
Yeah, that's okay for Jensen Huang. because he's got like, 700 million shares. But for the rest of us, that gets to be very, very lean, very, very lean once you start doing the math. Here we go.
And so let's look at these 5 names, and you're getting a low yield. What are the other issues with these mega caps that everybody owns?
Well, look, you need a ton of shares, right? So how much does that cost? So let's look at Microsoft, for example, which has the highest dividend of the Mag 7, and 1,000 shares is going to cost you only $430,000, and at a 0.85 dividend yield, that's going to give you about $3,600 a year. So that's okay if you can afford that much stock, but that's not that great a dividend, right? Most people can't just pile $500,000 into Microsoft, and frankly, that's not really moving the needle for you on an annual basis.
No, it is not. And most people, I mean, there's a lot of people where even 100 shares is hard. And look what you get out of owning 100 shares of Microsoft.
$365. Keep the change a little bit. You don't even get $365. So that's nice, but that's not going to pay a lot of bills, especially these days with gas going through the roof again. My goodness.
No, I mean, that's over the course of a year, every quarter, I would get enough money from Microsoft to fill up my truck, once a quarter.
That barely fills up a Dodge Durango, I'm pretty sure.
Yeah, you're not wrong. All right, so let's look at Coca-Cola.
So let's look at the great Coke. What a great company. Let's sell sugar water for 100 years. People can't get enough of it. So here we go. It's cheaper, right, on a dollar basis. So 1,000 shares, 78 grand, dividend yield about 2.71%. That gives you a little bit over $2,000 a year. That's still not great. So it's cheaper. You can buy $78,000 worth, perhaps, but that's still just not enough income, right? That's not enough income.
Yeah, and both of these examples are assuming the stock doesn't move at all. We've seen Coca-Cola going down into the doldrums. We've definitely seen Microsoft fall. I don't know how many of you remember when it went from over 500 to $370 over the course of 3 months. That ring any bells here? Yeah, I mean, these stocks can drop. Tech got absolutely hammered. And, once again, volatility, not our friend.
Maybe they need to start putting cocaine in Coke again, right? just a little bit. Isn't that true? There used to be a little bit in there.
There did used to be, but I'm going to go out on a limb and say that if Coke did that, they would probably all get thrown in jail.
I'd say it's worth a try. Okay, dividend stocks. Let's go. Let's take another look here. So this is it, right? You're not getting the growth. You're not getting the dividend yield. You need like a gajillion dollars to move the needle at all. And the best performing stocks in the market are too expensive, right? We need to own this significant size that I mentioned. And so they're just not as effective for that income generation as they used to be. And, in a world of fairly low interest rates and, perhaps going lower over time, we're in this new regime. And this is how, as I said yesterday, it's not your fault. This is just the new world we're in. We've jammed up risk assets. We're getting less and less for the risk that we're taking. And the old strategies aren't working as well anymore.
All right. Well, Hans, look like we have to scratch another one off the list. They're either too expensive, they're not giving enough return, or the stability of that dividend, if it is enough, is in question. So
there it is.
Yeah.
There it is.
So now I want to make something abundantly clear. And Gold Bugs, I'm talking to you. And my dividend people that were talking about that, I'm talking to you as well. We're not saying never buy bonds. We are not saying never buy gold. We are not saying never buy dividend stocks. We aren't. but you need to rethink what portion of your portfolio they fall under. You can't just buy gold and bonds and dividend stocks and expect to make income. You need the great income reset. This market, it's more volatile than ever. Buy and hold won't make you the income you want. You're not getting any income from gold. Dividend stocks, and especially the mega caps that everybody loves, where you're getting growth in dividends, they're going to cost you an arm and a leg to own. The boring kings of divs, they don't go up. And it's rendered a lot of these strategies kind of ineffective. Hans, when was the last time you bought and held something? And do you have any part that you're like, I'm never parting with this stock?
Well, not many times. Look, and especially these days, this is a trader's market. This is what we're realizing, and we talk about that with our other products, is that this is a moment where stock picking is starting to make a bit of a difference. Being on the right, not just being in the right race in terms of a theme, sector, you want to be on the right horse within that race. Just ask somebody who's owned like SMCI instead of NVIDIA for the past few years. You're going to know that that's important as well. So this is it. This is what it's all about, right? This is the great income reset, folks. And so in 2026, you're not going to just wait for your money to kind of come to you with these old tried and true strategies. You're going to need to be more active. You're going to need to seek that sort of consistent, balanced, repetitive income. So it doesn't have to be a ton of work, but it does mean you need to have a better diversified playbook. And tomorrow we're going to show you how we think about doing that.
Yeah, so Hans is about to reveal his dividend stock he loves. But looking ahead to day 3, this is where you're going to really put pen to paper, nuts to bolts, and you're going to be teaching everyone how you can create your own dividends and how your income strategy 7x'd the 60-40 benchmark in the last 2 quarters. You're going to teach everybody when to get strategically greedy and when to sit and wait. I'm excited for tomorrow, Hans. I'm excited to learn all of this.
It's going to be fun. It's going to be fun. And you know what, guys? When you learn this stuff, you are, as we said yesterday, you are already taking a big step by being here. You're already saying, listen, I want to do something that makes a difference to me, to my family, to my income, to my financial future. You are going to be learning things that 99.9% of people can't be bothered to learn. And that is adding another arrow to your quiver, right? A very, very powerful arrow to your quiver. And that's why, we continually strive to learn. I continually strive to learn because we want to set ourselves apart from the pack. And this is really one of the ways that we can do that.
Absolutely. So folks, tomorrow is going to be the day that you need to be here. Hans is going to be truly revealing how to reset your portfolio, to create income, to go after that stability, and have a new entire replacement of that 40 part of your portfolio. So Hans, your stock pick.
All right. So this is, if some of you probably know me and have been listening to me, I'm a big believer in trying to focus more on areas that are less disruptible. The world of code, right? Software, that's very disruptible. This is, that's an area where the tools keep getting better and better and better. And that's going to make it quite difficult for some of these software as a service companies to do well. Just because that's just the reality. They're not bad companies. They're just like we're talking about today, there is a new set of rules where there isn't a new set of rules is in the world of real stuff, of doing things, right? Stuff you can drop on your toe. Last I checked, Claude can't, whip up a bag of cement for me, or a spool of copper or whatever. And so I wanted to give you guys something, a good old kind of name here, which is waste. Well, it's not that old, but I remember when they came around. Waste management, right? So AI can disrupt software. It can't stop garbage, right? We're going to have garbage. We're people. We still do stuff. And especially in this world where we're going to be continually upgrading and retiling the world for AI, new data centers and, et cetera, et cetera, et cetera. That's scarce infrastructure. I like things that are scarce. I like that nice, dependable, repeatable kind of business revenue model that a company like this has. And so this is one of my favorite, going back to the oldies, kicking back with the oldies kind of name, a little bit of a dividend yield, but really in that area where I think you want to focus on real as you look out 3, 5, 10 years and you go, well, who's going to be around? These guys are going to be around.
Yes, they will. And what I'm excited about is tomorrow, you're not just talking about the waste management dividend itself. You're going to be talking about how you can create a second stream of income against this dividend and how to do that. And other ways to produce real income that can fall into that 40% of the old 60-40 portfolio. And I'm telling you, I can't wait for tomorrow. A lot of you guys know I'm a professional option trader, but I don't do a lot of option selling. So when Hans speaks, Hans teaches, I listen and I pay attention and I learn just like you guys. And I'm really looking forward to digging in tomorrow. The scavenger says you're trash talking, Hans. That's pretty funny.
Trash for cash, baby. I like that. Disruption resistant compounder companies.
Exactly. We've got, a lot of people are saying, I have a waste management dumpster I can drop on my toe. You could, Shane, that would be heavy. And sounds like my dad. I took a job at Waste Management 40 years ago operating heavy equipment because my dad said there will always be garbage. Had a long career there.
Okay.
There you go, gee whiz.
All right. I just made up a joke.
Okay.
What is a stock that stinks, but that you've got to have in your portfolio because it's going to do great?
What's that?
Waste management. It stinks.
It does stink. It does indeed. It stinks in a good way, though.
That's a bad dad joke.
Listen, dad jokes are like, they're like, like women enjoy the smell of perfume. I get that same feeling from dad jokes.
It's true. No one, it's like it's nourishing to us, but not to other people. But that's not the point. You're right.
Yeah, we've got a lot of people, say, "Oh, Republic Services." They love your idea, and do we have any specific questions around what we discussed today? Are the gold bugs all angry at us, or did we kind of make our point that, gold bugs? Are you mad at me? Are you mad at Hans?
Well, I'll tell you what, guys. I ran a couple of gold funds for about 10 years, and this is one of the beauties of income type trading. Is people would say, well, gold, what does it do for me? It doesn't give me a dividend. It just kind of sits there and sparkles. Well, I can create a dividend for gold. I can generate a dividend, an income stream from gold. And so hold that thought if you have a question about that, and show up tomorrow and we're going to tell you exactly how that works.
Awesome. That's a nice little teaser. Everybody, make sure you're here tomorrow. Same time, same place, same two people. We'll see if it's Clark or Mark tomorrow. Depends on whether my right eye calms down. And I look forward to learning more from you tomorrow, Hans. I'm excited. So
Thanks,
everybody,
Mark.
for Hans Albrecht, our head of income trading, I'm Clark Sebastian, one of many options, and I'm Mark Sebastian, your only option. We can't wait to see you tomorrow at 1 p.m. Eastern Time. Have a great rest of your trading day.